Hello everyone, and welcome to A Stitch in Tax, Saves Cash, the channel where we break down complex tax laws into practical insights that save you cash and keep you compliant. I am Olatunji Abdulrazak, founder and CEO of TaxMobile.online. If you are a professional in a partnership, managing a family trust or estate, or advising clients on tax planning under the new Nigeria Tax Act 2025, then this episode is specifically for you. Today, we are diving deep into how partnerships, trusts, and estates are taxed under the Nigeria Tax Act 2025. We'll be focusing specifically on sections 15 and 16, and I'll walk you through some real-life case studies to make it all crystal clear. Now, the Nigeria Tax Act 2025 isn't just a simple rewrite of old laws. It's a major overhaul designed to modernize and clarify areas that have historically caused confusion, disputes, and significant tax exposure. One of the most important of these areas is non-corporate structures like partnerships, trusts, and estates. These structures are incredibly common. We see them everywhere in law firms, consulting practices, family offices, and they are a cornerstone for wealth and succession planners. So, understanding how they rate taxed is no longer just a good idea, that's absolutely essential for staying compliant and planning effectively. Let's kick things off with Section 15, which deals with partnerships. The key principle you need to remember is that under Nigerian tax law, partnerships are what we call tax transparent. What does this mean? Simply put, the partnership itself doesn't pay tax. Instead, each partner is taxed individually on their share of the income or loss generated by the partnership. It flows through the business directly to the individuals. So, the next logical question is, what income of a partner is actually taxable? A partner's taxable income is made up of two main components. First, you have remuneration and benefits. This includes any salary or drawings you take from the partnership, allowances, interest paid on your capital contribution, and any benefits in kind you receive, like a company car or housing. For example, if you rate a partner receiving 5 million naira as a salary, and another 2 million as interest on your capital, that entire 7 million naira is part of your taxable income for the year. The second component is your share of the partnership's profits. After the partnership has paid out all the partners' remuneration and benefits, the remaining profit is then divided among the partners. This division is based on the terms you've all agreed upon in your partnership agreement. It is really important to note here that private expenses, things like your children's school fees or family holidays, cannot be deducted from the partnership as profit. They are not business expenses. Okay, so what happens when things don't go as planned and the partnership makes a loss? This is where the law provides some relief. If the partnership has a loss, your share of that loss is first used to offset any remuneration you received from the partnership. If your share of the loss is even greater than your remuneration, the excess amount becomes a personal business loss. You can then use that loss to set off against other taxable income you might have, subject to the rules in the Act. This is a significant relief, especially for professionals and small to medium-sized enterprises starting out or going through a tough period. Now, how are these profits and losses actually shared? It's straightforward. If there is a partnership agreement in place, you simply follow the agreement. That's the legally binding document. But what if there isn't one? Well, in the absence of an agreement, the law dictates that profits and losses must be shared equally among all partners. This really underscores why having proper documentation is so critical. A well-drafted partnership deed protects everyone and ensures there are no surprises come tax time. Let's talk about the administrative obligations you absolutely must not ignore. Each partner is responsible for filing their own personal tax returns. The partnership itself doesn't file a single return for everyone. The principal partner, or managing partner, has the duty to register the partnership with the relevant tax authority. Furthermore, any change in the partnership, like a new partner joining, partner leaving, or a change in the profit-sharing terms, must be reported to the tax authority within 30 days. Failing to register the partnership can have serious consequences. The tax authority has the power to assess the entire profit of the business on just one partner, or they can decide to allocate the profits arbitrarily among the partners as they see fit. This creates a massive and completely avoidable tax risk. Now let's move on to Section 16, which covers trusts, settlements, and estates. Whether these are created here in Nigeria or abroad, they become taxable in Nigeria as long as the income they generate accrues to Nigerian residents or beneficiaries. So, how is income from a trust or estate taxed? Section 16 points us to the fifth schedule of the Act, which helps us answer three fundamental questions. First, who is taxable? Is it the trustee, the executor, or the beneficiary? The rule is this: when the income is retained within the trust or estate, the trustee or executor is the one responsible for paying the tax on it. But when that income is distributed to the beneficiaries, it's the beneficiaries who are taxed on the amount they receive. Second, when is the tax payable? This follows directly from the first point. Tax is payable by the trustee when income is held back, and by the beneficiary when it's paid out. And third, where does the income arise? The Act considers whether the income comes from a Nigerian source or a foreign source. This framework is designed to prevent double taxation, but it only works if the trust or estate is structured correctly from the outset. Nigeria's approach here is very much aligned with global best practices. The flow-through model for partnerships is similar to what you defined in the UK and the US, and placing the compliance responsibility on trustees and executors for trusts and estates is also a common international standard. However, Nigeria adds an important layer of complexity: the need for federal and state coordination, especially when beneficiaries reside in different states across the country. Let's make this practical with a couple of case studies. First, let's look at a Nigerian law firm partnership. We'll call it ABC Legal Practitioners. Aid is the managing partner, Bisi is an equity partner, and Chike is a junior partner. The firm makes a total profit of 100 million naira. After paying out remuneration and interest on capital, there's 86 million naira left. According to their partnership deed, profits are shared. Aid gets 40%, Bisi gets 35%, and Chike gets 25%. When you calculate their individual taxable incomes, including their salaries and profit shares, Aid's is 46.4 million, Bisi's is 31.6 million, and Chike's is 22 million. The key lesson here is that having that registered partnership deed prevented the tax authority from making arbitrary assessments and ensured a fair and predictable outcome for all partners. Now for our second case study, let's consider a family trust estate. The trust assets are valued at 200 million naira and generate an annual income of 35 million naira. This year, the trustee decides to distribute 25 million naira to the two beneficiaries equally, and retain the remaining 10 million within the trust for future investment. The tax outcome is clear. The trustee is taxed on the 10 million that was retained. Each of the two beneficiaries is taxed on the 12.5 million they received. The lesson here is that proper structuring and clear documentation of distributions ensures there is no double taxation and avoids compliance disputes with the tax authorities. So, what are the practical takeaways for you? For partners, always declare your full remuneration and profit shares as part of your business income. Remember that your share of a partnership loss can help reduce your total tax exposure, and most importantly, register your partnership. Don't take shortcuts. For trustees and executors, it is crucial to understand exactly when income is taxable on you versus when it is taxable on the beneficiaries. And be aware that setting up offshore structures does not automatically place you outside Nigeria's tax radar if beneficiaries are resident here. And for tax planning in general, partnerships continue to be a very tax-efficient structure for professionals. Trusts and estates, however, must be very carefully structured according to the rules in the fifth schedule to be effective. To wrap up, the Nigeria Tax Act 2025 brings much-needed clarity, structure, and global alignment to the taxation of these common business and wealth structures. But remember, clarity does not eliminate responsibility. Compliance is absolutely key. If this video has added value and helped you understand these concepts better, please give it a like and subscribe to A Stitch in Tax Saves Cash. If you have any questions, please drop them in the comments below. I'll do my best to answer them. Thank you for watching.